option, basically there are only two types. One is call and one is put. Now, for every position, there are many kinds of strategy out there, whether it is a credit spread or whether it's a debit spread, whether it's a bull put spread, whether it's a bear call spread, whether it's an iron conduit or strangle. Now, whatever strategy out there, there are so many, right? And we don't care. We are not going to participate in every strategy. All this strategy is a combination of buying a call and buying a put, or buying a call and selling a call at the same time. It's a combination of call and put, and then they come out different kind of strategy. Now, so for our purpose only today, we only want to talk about the simple strategy, which is the call and put. All right, call and put. Now, every position is either make up of the call and put or combination of call and put. Now, let's take a look at the first one, buying a call. Now, we buy a call when you feel that the market is going higher, so you are bullish. You expect future market price to go higher, so you buy a call. So when you want to buy a put, this is the opposite. If you feel that the market is very bearish, expect future price to move lower, so you buy a put. So when we sell a call, when we sell a call, it means that our bias about the market is neutral and a little bit bearish. Now, when we sell a put, it means that our bias of the market is neutral and a little bit bullish. Now, neutral meaning to say that you don't expect the price to go anywhere. You expect the price to actually move horizontally, sideways. If your bias is neutral, you expect this price to just continue to trade horizontally. So when you are selling a put, your market bias is either that you expect that this market to continue to go sideways, or you expect the market to go a little bit bullish. So if I take a look at this example, right, SPOT, Spotify, right, is a very, very popular. I said, okay, well, I think this is, I put the horizontal blue line there, which is $100, which means that if I feel that this market, the share price is unlikely to trade below $100, so I say I go and sell a put. I'm selling a put. It means that my market bias is actually neutral. Neutral meaning I expect market to go sideways, or a little bit bullish means I expect price to go high. So that's what it means by neutral or a little bit bullish. So we say we sell a put means that we are neutral to a little bit bullish. Likewise, selling a call, it means that I'm neutral and a little bit bearish. Selling a call means to say that now I want to sell a call. Just if we use the Spotify again, right? Now the Spotify the price right now is trading at $124. $124. Then I say, okay, well, I am neutral to bearish. So let's say I put down there $162. So I sell a call $162. What does it mean? It means that I don't expect the share price to trade above $162. So long as the share price trade below $162 or towards a little bit bearish, means I profitable. Buying a call means you are bullish, you expect future price to go higher. Buying a put, it means you are bearish, you expect future price to go lower. Now, when you sell a call, it means you are neutral to a little bit bearish. When you sell a put, it means you are neutral to a little bit bullish. Now, what is options? Option is where you have call and put. Option, you can have both the call and put. It can be either buy or sell, right? There's no difference when you trade stock. Now then, some people say, why not you trade stock and why you want to trade option? Because of the leverage. So when we trade options, it's the same thing when you buy a stock, right? If you think the stock is going up, you buy the stock. But in option, we buy a call. Now, if you think the stock is going down, in the stock market, you cannot short the stock, because if you think the stock is going down, you cannot, right? So by in option, we can buy a put, right? Just like as I mentioned just now, when you are bullish, we buy a call. When you are bearish, we buy a put, right? So option give us the kind of flexibility to participate, whether the market go up or the market go down. We can participate in both directions. Now, even when the market goes sideways, we can also participate. We use iron condor, the strategy, right? So that is the benefit of trading option instead of just trading stock, because stock, we can only make money when the price goes up, okay? When the price goes sideways, we can't make money. When the price goes down, we can't make money. So it's only one direction. So now, next, buy to open. Now, what does it mean? It means that when you want to buy a call or when you want to buy a put, we always key in buy to open. Now, when you buy to open, means that you long. Long means you are bullish. Now, when you buy, you need to pay. So that's why we say debit. Whenever you buy a call or whether you're buying a put, you need to pay. We call it, that's why the money will go out from your account. We see that's a debit. Now, when you want to sell a call or sell a put, sell means you are short. Short means another word for selling is we say short. Now, when you're selling something, we always receive money. What are the difference between what are the situation when you want to buy a call and when the situation when you want to sell a put? The difference between buying a stock and buying an option. You can see that, let's say a stock is now trading at $100. The stock is trading $100. Now, if you want to buy 100 share, you must have 10,000 US dollars. But when you are using options to trade this underlying stock, all you need is $8 because option premium is only $8. So $8 multiply 100 share. All you need to have is your account have $800. You can already participate in the movement of the stock. And for stock, the maximum reward is unlimited. If the stock price that you buy goes up, of course your reward is unlimited. But when you are using option to trade, your reward is also unlimited. Now for stock, what if that company share price gone to zero, then you lost $10,000. So we say that maximum risk for stock investing is the money that you put out, right? But for options, your maximum risk is only the premium that you pay, which is $800. Now, when we calculate the ROI, return of investment, or return on investment. Now, if the stock that you buy rally up $3, in stock, you make 3%. But in options, your ROI is 18.75%. So that's why in all aspects, you can see that buying option, right, on the stock that you're interested is actually much better than buying the stock itself. Buying a call options, as we mentioned just now, when you buy a call, it means that you are bullish. You expect future price to go higher. A call buyer pay a fees to the call seller for the right to buy the stock at the strike price. This is AT&T. Now AT&T right now is trading at $28.45. And you believe that AT&T, the price is going up in the future. So you can name whatever price you want, your strike price. We say, okay, I want to buy a call on AT&T with a strike price $27, and this contract, this option will last until 19th of June. So what you're simply saying is, I expect AT&T, right, from now until June 19. This AT&T, as long as it stays above $27, then you make money. That's what you're saying. That's why you're buying a call. You expect AT&T to go higher, rally to $30. So from $27 to $30. ROI in stock is 11.1%. But your option also increased. Your option actually increased from 430 to 610. Your ROI in option is 48.9%. Okay, let me show you how we calculate this. So let's say that we have two types of trader. One buy AT&T the share. The other one buying the AT&T options. So what's the difference? Now, when you buy AT&T, T means this ticker symbol for AT&T. So you buy a call option because when you expect this AT&T price to go higher, you buy a call option, and your strike price is $27. You can see here on my cursor pointing here is $27. Strike price $27. This contract expires 19 June. So now you can see there's a bid price, there's an ask price. When you buy a call option on AT&T expire on 19th of June, you have to pay out $4.30. Right, that is the premium that you pay out. That means to say that from now until 19 June, you expect AT&T to trade above $27. If you trade above $27, you make money. That is when you buy a call options. That's when we buy a call option, right? So when we buy a put option, it means that you expect the stock price to move lower in the future. Put buyer hope for a lower price. Put buyer has the expectation that underlying security, which is the stock itself, is going to move lower. That's the reason why you want to buy a put. Buyer pay a fees to the option seller for the right to sell at the strike price back to the seller. So as a buyer, we always have the right, and for that right, you must pay a premium to the seller. Okay, which we cover on the previous sessions, right, last Sunday. Now, option seller. Now, so far what we have talked about just now is the two examples. One is buying a call, one is buying a put. You buy a call if you expect price to go higher. You buy a put if you expect price to go lower. Now, if we have a buyer on the option, we also need a seller of the option. Now, option seller on the other hand, right? Options traders sell options to bring in income. Now, because you are selling option, means that you have obligations where, either to buy the stock or to sell the stock. For that obligation, buyer of the option must pay you a premium. So we are the seller, right? We sell an obligation, just like the insurance company, which I mentioned. I always use this example. If you own a car, you need to buy a car insurance on your car. Now, let's say you go to an insurance company, buy for 6 month insurance. Now, during 6 months, if you don't get involved in any car accidents, the insurance company will keep the premium. There's nothing happen. Then you renew your insurance again. You buy another 6 months. You pay the insurance company another premium. So when we come to option, it is the two party here. The option buyer is just like car owner. The insurance company is the option seller. So we prefer to be the option seller because we know the car owner, the chances for the car owner to get into accident is very low, right? So if nothing happens, we keep the premium, we sell insurance again. So we prefer to sell insurance as an income. That's why option seller, we sell option to bring in income, right? Seller of the call option has the neutral to bearish buyer's view. Seller of the call option hope that the price will remain stable, start trading in a sideways movement or even go lower, right? So that's the seller of a call, which I explained just now. Now, seller of the put option has a neutral to bullish view. Seller of put hope that the price will remain stable. In other words, it remain ranging or even go higher, bullish, right? So that is the difference between the two different call seller and put seller. Seller a call. Let's say take this example, Spotify spot, right? We sell a call, 160 strike price. Last session we talked about the strike price, right? What's the meaning of strike price? Is the price both the seller and the buyer agree to change for their share to change hand. So now let's say I want to sell a call, 160 strike price, and this contract will end on the 17th of April 2020. So what do I mean? What I meant is I expect Spotify, the share price, to trade below $160 from now until 17 April. If during this, from now to 17 April, if Spotify, the price trade below $160, I win. Right? So that means that as a call seller, we prefer the market to stay in the stable, trade sideways or a little bit downward. We do not want the price to go above the strike price, which is $160. Now that's the reason we sell a call. And when we sell a call, we receive a premium. So now we sell a call on Spotify. This is the same example. Now take a look at this, $160. We sell a call, right? You can see here, this is the center here, this is a strike price, this is a call. You see, we sell a call at strike price 160. It will end at 17 April 2020. And for that, for selling that call, we are receiving 15 cents, right? 15 cents. For this contract created from now until 17 April, we have another 27 days to go for this contract to end. So now if I sell a call, let's say for strike price $160, and that means I will receive a premium of 15 cents immediately. Now what happened? Now let's say from now until 17 April, if Spotify, the price trade below $160, the strike price, that means that this option contract will expire worthless. And after this date, 17 April, I have no more obligation. Then what I just simply keep my premium and I resell again. So that's what we mean by we're selling call or selling put to create income. Now, you also realize there's another green box here. Now, people say, Benny, why not you sell higher or you sell lower? We are selling a call. Now, they say, okay, to collect 15 cents as a premium is too low. How about I want to collect more? I want to collect $6. Why not we pick up income of $6.40? Why we pick 15 cents? Now, if we pick $6.40, that means our strike price is 130. 130. The current price is 124. So from 124 to 130, you realize that right now 124 is here. Now, if we sell a call at 130, which is here, that means that if the price trade above 130, we lose money, right? So you realize that if you pick a strike price which is very near to the current price of 124, the chances for the price to trade above 130 is very high. That's why the buyer option pay you a very high premium. Just like when a car owner, and this car owner is very young, he just passed his driving license, he's very rich, and he go and buy a sport car, and he approached the insurance company. He want to buy insurance on his car. The insurance company will ask a few questions. How long you have passed your driving license? You say, oh, I just passed my driving license 1 week ago. What kind of car are you driving? What kind of car are you going to insure? I will insure on my sport car. Now, the insurance company will still insure the car, but they will ask for a very high premium because they know that the chances for this young driver driving a fast car, the sport car, to get into an accident is very high. The probability is very high. So they still sell them the insurance, but at a very high premium. So when we translate that to option trading, it's the same. Now, if you sell a strike price 130, which means that from the current price 124 to move to 130, it is very likely it will happen. Chances like it will happen. That's why you are receiving a very high premium, right? So we have to be balanced, right? When we sell a call options, we say that we want to sell a call option to receive income, but we do not want the price to trade above $160. We'll make sure the probability for the price to go above $160 is very, very low, right? So you need to be balanced. So this here, the bid and ask price it shows you the premium that you receive. A put seller is the opposite. A put seller receive premium as an income as well, because just now we have discussed is a call seller. Now it's a put seller. Now seller or put, what does it mean? Seller do not want seller, they are a little bit neutral to bullish. Just now we say the call seller is neutral to bearish. Put seller is neutral to bullish. Take an example about this AT&T. When I look at the price, now it's trading at $28.45. So let's say, okay, I say, okay, well, I expect, I don't think the AT&T price can trade below $27. Just example only, yeah. I don't believe that. I think that there's a very strong chance that AT&T price will go higher from here on. And therefore, what I want to do is I'm going to sell a put with $27 strike price. So what I mean is, so long as AT&T price trade above $27, I make money. AT&T, right? $27 strike. Now $27. Why $27? Because I picked this is a strike price I pick. I believe that AT&T price unlikely to trade below $27. So I pick $27 as my strike price. Then what do? I sell a put. Now when I sell a put, I receive $2.21 as my premium. Now this is, you may say $2.21 is actually how much? $2.21 per share. So if I sell one contract, which is equivalent to 100 shares, so the moment I sell a put on AT&T 2027, right, for $2.21 for one contract, which equivalent to 100 shares, it means that $221 US credit to my account immediately. Now then, this contract is only last until when? Last until 19th of June, which is 90 days from now. So what I mean, when I create a contract like this, what it means in simple English is, for the next 90 days, so long as AT&T price trade above $27, I will just keep my $221 as my premium per contract, and nothing happened. Then I will repeat again when this contract expires, right? So that's what we mean by selling a put. Now, to summarize, right? When we buy a call, debit means why? Because we buy. So whenever we buy, we need to pay a premium, right? When you buy a call, it means that you are bullish. You expect future price to go higher. Now, if you expect future price to go lower, you can buy a put. right? You can buy a put. So again, because we buy, we have to pay a premium. So we say debit, right? You are bearish. Now, when we sell a call, we receive a premium. That's why we say credit. This premium, the premium that we receive immediately credit to our account the moment our trade get triggered. This money go into our account immediately, and you can use this money to start another new trade, right? This money for you to use immediately. Now, when you sell a call, it means that you have a bias that the market is actually slightly bearish to neutral. You prefer the price to stay sideways or down. Now, if you believe that, if you take as the example AT&T, $27 strike price. If you believe that AT&T are likely to trade below $27 in next 90 days, we can sell a put. When we sell a put, we receive a credit. So when we sell a put, we are actually a little bit bullish to neutral. The market doesn't have to go up, trend doesn't have to. All the market need to do is remain neutral, remain sideways, remain no direction, remain sideways movement, or a little bit bullish. That's all we need, and we make money. Why we prefer to sell put? We are a little bit bullish. When we buy a call, we are bullish. So why not we just buy a call? And why we need to sell a put? The reason is simple. Because the market can only have three directions. Uptrend, bullish, sideways means no direction, or downtrend, which is bearish. Market can only be in these three directions: uptrend, sideways movement, no trend, or downtrend. Now, if we are bullish, we buy a call. When we buy a call, we can only make money if the market move higher. If the market move sideways, we lost money. If the market move down, we lost money. So this is when you are bullish, when you buy a call. Now, instead of buying a call, I say, well, I'm bullish. Why not I sell a put? What's the difference? When I sell a put, I'm still bullish. I'm slightly bullish. How I make money when I sell a put? When the market move up, I make money. When the market remain horizontal, sideways, no direction, I still make money. I only lose money when the market move down. So buying a call is the same. When the market moves down, you lose money. When the market goes sideways, you also lose money. You can only make money when the market go up. So if you take a look at this metric, you realize that when you buy a call, right, your chance of making money is 1 out of 3 environment. Means the market has to be go up. Market go sideways, you lose money. Market go down, you lose money. But when I sell a put, my probability is 2 out of 3 I'm making money, because all I need is market do not become a downtrend. Market can go up, I make money. Market can remain sideways, horizontal movement, I still make money. Market just don't move down. So that's the reason why we prefer to sell option and not to buy options. Now, another one, when we buy a put, it means we are bearish. When we sell a call, we are also a little bit bearish to neutral. Why not we buy put? Why we sell a call? Both buyers are the same. The second and the third, we have both the buyers is bearish. Why not we sell a put? Why not we buy a put instead of just selling a call? Again, we are talking about probability. Now, when we buy a put, the only time that we can make money is when the market start moving lower. That's the only time we make money. If the market start to move horizontally, we lose money. When the market move up, we lose money. So 1 out of 3, we make money. 2 out of 3, we lose money if we buy a put. Now, if we are bearish and we decide to sell a call, now when we sell a call, our bias is same as buying a put. We are same, but we sell instead of buying. So what is the difference? The difference on the odd, because there are 2 out of 3, we are making money. When we sell a call, the market can go sideways, we make money. Market go down, we make money. The only time when we lose money is when the market go up, which is similar to buying a put, but we have better odds. So that's the reason why we do not want to buy options. We want to sell option, because our odd is 2 out of 3, we make money. When you buy an option, your odd is 1 out of 3, you make money. Okay, so I hope you you can understand why we prefer to sell options. When you are bullish, it means you expect future price to go higher. You can buy a call or you can sell a put. If you are bearish on the market, you can sell a call, right? When you sell a call, you are bearish, or you can buy a put. The same thing, when you buy a put, you have to pay a premium. When you sell a call, you receive a premium. So I prefer to receive premium rather than paying a premium. When you buy a call, this is a graph usually you see quite often with an option trader, right? And sometimes you don't really understand. So let me explain to you, yeah? The horizontal line here, let's say the stock is trading at $100. You are bullish, so you want to buy a call. So when you buy a call, you need to pay a premium. Let's say the premium is $3, right? You are bullish, so you buy a call. So at $100, you buy a call, so premium $3. So immediately you buy a call, you already negative. Now, if the share price start moving from $100, move up to $103, now your position is break even because your premium payout is $3. Now, if the share continue to go higher to 105 to 110, you're making money. This is when you're buying a call. Now, your $3 premium that you pay out. Now, what if the share price goes down? You buy a call, you are bullish, but instead the share price goes down. Let's say the share price goes down to $90. From $100, it moved down to $90. You're losing money. So how much you lost? If you buy a stock, you lost $10. Multiply 100 share, that's $1,000. But if you buy a call options, your loss is only limit at the premium you pay out, which is $3. $3 multiply 100, you lost $300. Now, what happens if the share price move down even lower to $80? $80. If you are investing in stock, you buy $100. Now share price go down to $80. Every share you lost $20. Every share you lost $20. Multiply $100. That is your loss if you buy a stock. But if you buy a call options, the loss is only the premium that you pay out. It doesn't matter how much the share price go down. Your maximum risk is only the premium they pay out. Or that's how we explain the graph. Maximum risk $3, right? Regardless of where the price goes to. Now, when you are selling a call, selling a call is the opposite. Let's say the share price is also $100. When you sell a call, whenever you sell option, you receive the income. You receive a premium. So when we sell a call, we receive $3 premium, example. So $3 is your income. Now, if the price, when you sell a call, it means what? You are actually bearish. Now, if the price go up from $100 to $103, $100 to $103, the price goes up, you are break even. If the price go even higher, $110, you start to lose money. Now your graph is -7. But on the other hand, if the share price from $100 start moving lower to $90, income remain $3. No change. So it doesn't matter how the price goes down, you still make $3. Right? So we say that when you are selling an option, your reward is limited at the premium that you receive. Buying a put, you are bearish. So if you buy a put, the stock is trading at $100. So if you buy a put, you have to pay a premium $3. So immediately you lost $3. Now when you buy a put, you are bearish. If the price go down further, you make money. So if the price go down to $97, that's your break-even price because your premium is $3. So if the share price is $97, that's your break-even price. Now if the share price continue to move lower to $90, now you start making money. But what happens if the share price go up? You're buying a put. If the price goes up, you're losing money. But how much you lost? It doesn't matter how much the price goes up. Your maximum loss is only $3, the premium you pay out. Selling a put is income received in premium. So let's say the share price is trading at $100, you receive a $3 premium. So when you sell a put, you are bullish. So if the share price goes higher, no matter how high the share price goes up, your maximum reward is only the premium that you receive, which is $3. Selling a put means you are bullish. So what if the share price start moving lower? If the share price move from $100 to $97 and you collect $3 as your premium, so that is your break-even price. If the share price continue go even lower than $97, that's where you start losing money, right? Because we say selling put is bullish. The market goes up, then you make money. Market goes down, you lose money, all right?